Good morning and welcome to the Morning Spotlight Podcast. I'm your host, Mike Ham, and we are coming to you, as always, from the Spotlight Studios in Morristown, New Jersey. Our guest today is a financial planner and member of the Bank on Yourself organization. He helps real estate investors, business owners, and full-time employees grow safe and predictable wealth regardless of market conditions using a financial strategy that has been around for over 160 years. He started this journey when he was in grad school, completing his MBA. He's worked for companies like Allstate, Blue Cross Blue Shield, Cigna Healthspring, and Humana before founding Financial Asset Protection, a financial services firm that focuses on one sole concept, the bank on yourself concept, also known as the infinite banking concept. He is Sarry Ibrahim. Sarry, welcome.
Hey, Mike. Thank you so much for having me on.
Absolutely. Thanks for coming on. So let's get to know you a little bit more, because one of the things that I like to do is just we're going to talk about all the technical stuff that you came on here to talk about, but I like to get to know the person a little bit. So just give us a little bit of a background on yourself outside of the stuff that I just talked about.
Yeah, definitely. To kind of dive a little bit deeper, a lot of this started when I was doing my graduate program, and kind of when I was at Allstate, I shift from working with small business owners and individuals and protecting auto insurance, homeowners, commercial insurance, and then jumped to the healthcare world. And I was working with retirees who were 64, 65 years old, merging off of their employer plans onto their own individually owned Medicare plans. So that was my job for a couple of years, helping them as a consultant. And I started to build a relationship with these clients. And during that time, one of my clients asked me if I could help him with life insurance. And he even said something like, it has cash value, it builds up over time. And I had no idea what he was talking about. Yep. But I still had my life insurance license. I had to at that time. And I told him I would do more research for him and I would get back to him. And I went to Amazon and I started searching for books about life insurance. And I came across this book called The Bank on Yourself Revolution by Pamela Yellen. And the book pretty much talks about this concept, the bank on yourself concept, or the bank on yourself strategy. And it's the utilization of cash value life insurance while you're still alive, of course, and to be able to use the cash in the policy to become your own source of financing, to use for your business, to use for real estate investing, pretty much to use for whatever you want. And with doing that comes a lot of benefits you can't find in other financial vehicles. I'll definitely get into more of that later, but that's pretty much how I found this. And I really liked it because it was a way for clients to recoup their insurance costs and all the other costs associated with doing business. And that's kind of something that I really like. If this life insurance couldn't do all these things, I probably wouldn't be involved in this business. But that's pretty much, what I do right now and who I am.
Gotcha. And you're coming from Chicago, right? That's what you told me. Okay,
yeah.
Cool. Have you lived there your whole life? Is that you moved to Chicago?
Yeah. So I grew up in Chicago my whole life. I grew up in, for those of you familiar with Chicago, on the southwest side, the southwest suburbs of Chicago. And then 2 years ago, got married, and my wife and I live now on the north side.
Oh, great.
Near where the Cubs play.
Oh, sweet. That's cool. I've always wanted to go to Chicago because I'm a big baseball guy. I don't know if you knew that. Big baseball fan, Yankee fan. And Wrigley Field is obviously a bucket list place for me to want to go. And even as a Yankee fan, I'm a big Fenway Park fan. I love Fenway Park. It's quick sidebar. Anyway. All right. So how do you go from maybe you touched on this, but I just want you to kind of flesh it out a little bit more. So you're working for all these different companies, right? Getting your MBA, and you're in grad school. At what point do you decide to kind of go out on your own and start your own little business?
Yeah, good question. It started so when I was doing the Medicare stuff, that's technically when I was self-employed, and it kind of a light bulb went off in my head. It was all right, if I could help, if I could do this in any state, over the phone, online, and I could actually provide a solid solution. And this is a recession-proof solution. And it doesn't matter how the stock market is doing, how the economy is doing. I can make a pretty decent living doing this. And I didn't know, I still was kind of naive with insurance and financial services because I was still new to it. But I knew that, I only needed a small amount of information to see something much bigger. And that's why, I founded my own business. And then pretty much when I found out about the Bank on Yourself strategy, after reading that book, I did two things after reading that book. One is I bought my own policy, and I'm utilizing the Bank on Yourself strategy now. Also, I went through their training program. They have an 8-week training program that you can go through. And I went through that. And then pretty much Financial Asset Protection is a financial services firm that specializes mostly on the Bank on Yourself strategy. And for those of you not familiar with it, it's also known as the infinite banking concept. A lot of people know that term too, especially in the real estate and financial services world.
Right.
So pretty much that's how, I kind of blended it together. And I being self-employed is the best thing I've done because it was the hardest thing I've ever done. But at the same time, it's kind of like a challenge with a reward that's not instant gratification. Of course, it's delayed reward. And I'm still building it up. That's why I'm doing all this podcasting and everything, because I still want to spread the message about the strategy to help other business owners and real estate investors and everybody else. But that's pretty much how I put all this together.
Right. And are most of your clients local to you, or are they national clients? So how does that work?
Yeah, actually, most of them are national. So it's
Okay.
all my business is done over the phone or on Zoom. And yeah, it's, for example, if I have a client who's in Texas and I'm not licensed in Texas, we could still talk, we could still do the consultation, everything. But when it comes time to execute and actually submit the application, I'll go get my insurance license for that state. The cool thing is about insurance is that it's more flexible. I know, like, I have friends who are like lenders and mortgage lenders, and it's not that easy just to get licensed in another state. It's
Right.
So that's one thing I like about what I do right now.
Gotcha. Well, most of my listeners are in New Jersey and New York, so hopefully this opens up a different market for you. So that would be great, because then it's actually like the show's actually working, like doing what it's supposed to do.
Yeah.
All right. So take us through the types of services that you offer. I know you've mentioned it, but let's just do like we're doing basics right now, and then we'll get into some of the more stuff, especially on the real estate end, because obviously, like we talked about on the phone before we did this call, most of the people that listen to this show are real estate focused in some way. But just some of the services that you offer and why this show and you were able to be a good fit for my listeners.
Yeah, absolutely. Awesome question. So pretty much it comes down to utilizing the strategy called the infinite banking concept, or the bank on yourself strategy. And what this is, Mike, is that it is the utilization of whole life insurance. So there's pretty much three types of life insurance. One is term, the other is whole life, and then the third is universal. Term is like a set period of time. It's like 10 years, 20 years, 30 years. It has a start date, it has an end date, and there's no equity in the policy. It's just a life insurance only. Whole life is for your whole life. There's a start date, and the only way it finishes if you stop paying into it or if you pass away. And there's equity in it. It's like buying a home. You have the market value and you have equity in it. Same thing with whole life. And the universal is a combination of term and whole life. I won't get too far into it, but it's pretty much a combination of those two. But for the purposes of using the infinite banking concept, we're talking about whole life insurance with cash value. Now, people always ask, why do real estate investors use this? Why would they have whole life insurance that they're paying into? Well, because of a couple of things that this policy could do is that this policy, you could build up cash in it. And then as you're building up the cash into this policy, it's earning dividends and compound interest from the insurance company it's a part of. It's almost, I don't want to say it's an investment, but it works similar to other investments. It's mostly a saving strategy. So as you're saving into this policy, you're earning compound interest and dividends from insurance companies that have been around for over 160 years. So there's a lot of certainty and predictability with these policies. And as you're building up the cash in the policy, you're able to access this money up to 90% of the cash value via loan at any time for any reason. So then another question that arises is, why do people borrow their own money? And the reason why is because of, in investment banking and other forms of banking, there's, an arbitrage split where you have this cash reserves and it's earning, for example, 5% compound interest. And when you borrow it, you would borrow at an interest rate much lower, like 2%. So this way you're able to use that money, borrow it, and still earn compound growth on your money without interrupting the growth of it. Because for a lot of real estate investors, I've kind of seen this with my clients, is they have these problems on both sides of a spectrum. Like, they want to save their cash, obviously, because they're doing real estate investing for cash. They're doing it for financial rewards. But at the same time, they don't want to have their cash sitting in a bank account, not earning any interest at all, not moving. There's a loss of opportunity cost there, and there's a loss to inflation. So they need their money moving, but also at the same time, liquid. This is what the bank on yourself strategy could do. It could do both of those worlds. You could save the money, borrow at a lower interest rate, use that money for real estate investing, for down payments, or to actually finance a whole deal, partnership, syndication, and then pay that back on your own terms, making you essentially your own bank or your own lender. And of course, a lot of people can't start off with just financing an entire property on their own, using the bank on yourself strategy, but it's like a mindset shift, and it's a step-by-step process that you would first start off using for down payments, and then you would build it up to the point where you can finance your own property. And then, of course, doing so, you have the compound growth, and you have the access to the money. And also, as mentioned, these companies have been around for over 160 years. So we're not talking about risking your money and risking, borrowing against all the principal at a risk. It's the opposite of that. It's a safety net for the risky investments that you're doing.
Okay. All right. My head's spinning now, man. This is why we have you on, because then you could explain it better. And, then if people do want to use you, then this is why, because it seems like it's beneficial, but I wouldn't know the first thing about how to get that started, which is where you come in. So can you describe how a bank on yourself type whole life policy could be structured?
Absolutely. Yeah. So there's some of them that are paid monthly. Some of them are paid annually. Some of them are paid for one's whole life. Some of them are paid for 7 years, 10 years, 20 years. They have a start date and an end date, even though they're whole life insurance. And then some of them are single premium cases. It all starts with a financial analysis. This is where we go. It's about 60 to 90 minutes long. We go through everything. We take a deep dive into cash flow, current assets, retirement plans, what their goals and needs and wants are. When they plan on retiring, are they already retired? We take all these things into consideration to figure out what kind of policy, because we work with 3 insurance companies, and each insurance company has like 5 different products, and each product has different funding amounts and different frequencies. So it's almost impossible for us to kind of guess on which product and at which amounts, which is why we do the financial analysis. To kind of dive a little bit deeper, I had one client who is a real estate investor. He sold one of his properties for $400,000 in cash, and he wanted more liquidity. He didn't want to just roll it into another property. So we put together a single premium policy for him. That's like a one-time payment. It's almost like buying a house cash or buying a property cash. He bought the single premium policy, and as soon as he did that, 2 things happened. One, he had instant cash value of $375,000 in cash value. And the second thing that happened is he had a death benefit, a life insurance amount of $580,000. Now, both of these, the cash value and the life insurance, grow every single year without any further contributions. They both grow. The cash value earns compound interest and dividends, and he has access to this money. So he can go back, and now he can finance a whole property using his policy. He can pay back the terms on his own terms. He can pay back the principal and interest, and then he's earning compound interest on his money. Also, in a lot of states, in most U.S. states, the cash value of a whole life policy is protected from creditors and bankruptcy. So this is a powerful asset protection tool for a lot of real estate investors and people kind of have a lot of cash and are using it, of course, for real estate investing or for other businesses, is that they can, this is a hedge against that kind of risk. Of course, I'm not an attorney. You want to consult with an attorney before doing this, but you could verify it. Every state has its rules on cash value, life insurance, and annuities, and double check that, and you'll see there's a lot of protections towards it.
Right. That was going to be my next question is since you're in Chicago and I'm in New Jersey and you mentioned Texas before, what would be if this is the same across every state, or if it differs, different policies, different, procedures that you have to go through? Is it less beneficial to do it in some states and more beneficial to do it in other states?
Yeah. Good question. Yeah. So there could be differences with it. Like, for example, with tax rates, and there could be tax liability involved with whole life policies. Like, there's something called a modified endowment contract or a MEC policy. That's when a whole life policy loses its tax advantage and becomes a modified endowment contract. And then that depends on the state you live in. But what we always do is, to make things less complicated, what we'll do is we'll ask the client if they could have their CPA on a call with us. And this way we explain the insurance policy, and the accountant explains the tax liability involved. So that's one state to state difference. And then also, as far as asset protection, we ask them if they can have an attorney present, just to make sure that in fact, in their specific situation, that the cash value would be protected. Of course, in some situations where like a client's already involved in a lawsuit, and we don't know about that, then the cash value probably is not protected. So certain things like that, intricate things like that, we would outsource that, or have the client outsource that to a qualified professional. But as far as how it works, it's typically pretty standard. A lot of the insurance companies use federal laws across all 50 states. And most insurance companies we deal with are present in all states. I think one of the companies we deal with is not present in New York. New York is a little bit tricky for insurance companies. It's like California. It's a little bit tricky when it comes to insurance and financial services. But for the most part, all the insurance companies are present in all the states. So they have pretty standard procedures and processes in place.
Yeah. Okay. So one of the things that I think would be interesting to know is that, we were just talking about these different states and how different states handle these things differently. what has been the impact? Because, we're recording this on December 8th, 2020. I mentioned that it's probably going to post February 2nd, 2021. So there's going to be a gap between when we're actually recording this and when it actually posts. What has been or if there is any, the impact of COVID on this stuff? Like, is it harder to get these policies? Are insurance companies underwriting them differently? Has it changed your process in any way?
Yeah, definitely. It's changed for good and bad. With bad, because obviously it's a worldwide pandemic. So that's obviously, and insurance companies are in the business of insuring people's lives. So as soon as COVID happened back in March and April, insurance companies had their antennas up and they were denying a lot of cases. Even if somebody had COVID like a month before, they would still deny it and say you have to wait a year or sometimes 6 months, because the insurance companies, even medical professionals, are still unfamiliar with this disease. Or this virus, sorry, and pretty much, so these insurance companies don't know yet what to expect. That was pretty much the worst thing about it, is that postponing the cases or even denying some cases because of uncertainty. And then the flip side to it, the good part to it is, or the good thing for this concept is that because we're dealing with insurance companies that have been doing this for over 160 years, and they've been paying dividends and compound interest, even during the Great Depression, during the 2008 market crash. These insurance companies, they're regulated differently than other financial institutions. So in other words, they can go through a storm, they can go through a pandemic, and clients, when they know that, they would prefer to have their cash sitting with an insurance company like this through cash value life insurance, or in some cases annuities, rather than having it sit in the stock market. Right. So we've been seeing an uptick in business from that perspective of the uncertainty. And yeah, the stock market is doing good now. It took a little dip in March, April, but now it's doing good. And I don't know, I've been hearing a lot of talks about next year, new president in office, how it's the effects. I've been hearing a lot about real estate, and especially multifamily being affected due to the upcoming mortgage default rates, because people, a lot of lenders kind of deferred their payments until next year, but a lot of people aren't going to be able to pay that. I've heard in some situations people have to pay like lump sum, like 6 or 7 months of their mortgage, or else
insane.
Yeah, exactly, which is insane.
Yeah.
Yeah. So I don't know what's going to happen. And I think that that's the point of the bank on yourself strategy, is that if you don't know what's going to happen, you could park your money somewhere that's safe, grows at a guaranteed rate in writing contract with an insurance company that's been around for almost 200 years, and still have access to it for investments that you want to participate in. It's not an either or approach. It's not either real estate or whole life insurance. You can kind of integrate those together.
Okay. All right. So, you're somebody that owns his own business, right? I would like to own my own business one day. I don't know what I would do. Maybe this, maybe something else. I don't know. But if you're someone that owns their own business, or if you're an investor or whatever it is, which would you prefer and why? Investing in your business or saving cash? I already think I know what you're going to answer, because I think this is like a softball one that may or may not have been on the pre-show notes. But what would you prefer?
Okay, awesome question. So I'll answer this a little bit differently. 2 years ago, I would have answered 100% back to my business. Every penny that I make, even if I'm kind of short on my bills, I'll reinvest it into my business. And then as I've gotten more experience and worked with Bank on Yourself professionals and other financial experts and accountants, I've kind of realized that if you keep reinvesting every dollar back into your business, you defeat the purpose kind of your business. Is that you're in business to make cash. So if you're unable to retain that cash somewhere and have it grow predictably, then you're kind of in trouble. And especially a lot of businesses before the COVID, and I keep talking about COVID because it's such a big deal with financially.
Well, I don't know if you've heard, it's basically taken over this entire year.
Exactly, yeah. So a lot of businesses, the thing about businesses who constantly kept reinvesting back into their businesses and had no cash reserves at all. Business Insider wrote an article on March 2020 about this subject, and they got this data from JP Morgan Chase that analyzed 597,000 small businesses in the United States and found out that only 50% of these businesses can go 27 days with zero income. After that, they're pretty much out of business, but only 50%. The other 50% cannot do that. They can't go even 27 days with zero income because of the lack of cash reserves. So I think rule number one to business is you need cash reserves. You need a way to retain your profits and to retain your revenue in between earning your money and spending it. Because if you have a business and you make $1,000 a month and you spend $1,000 a month, and you have a business, you make $1 million a month, and you spend $1 million a month, there's no difference between those two businesses. One has much higher revenue, but at the end of the day, if there's no cash in the owner's pocket or the executive's pockets, then there's no business in reality, because you're doing all this for cash, So I've kind of not figured out a way, but learned the way, because I didn't invent this stuff. I'm just utilizing it.
Yeah.
That if I have in between earning my money and spending my money, I have a vehicle that I could put money into and then take money out on the other side, but still be able to retain the middle of it. Then I think that's the priority, is retaining in the middle, and then I can reinvest in my business. But before I reinvest, I make sure I have cash reserves, and I make sure I'm allocating a percentage to those cash reserves, no matter what, whether business is up or down. The cash reserves are still being built, because I don't know what's going to happen next year. Nobody knows what's going to happen in March 2020. So
a safety net.
Yeah, exactly.
Safety net. Yeah.
Yes.
Okay. Cool. So I want to get more back into the real estate investing stuff, because obviously, like I mentioned before, I mean, we touched on it a little bit. Obviously a lot of the listeners are involved in real estate in some capacity, and the majority of the shows that we do are real estate focused shows. So I want to take it a step further. Like if somebody's a real estate investor and they come to you, like what are some common questions or concerns that they have when they do bring this type of they want you to help them with this bank on yourself concept and everything, and help them with the real estate investment. Like what are the hesitations, I guess?
Yeah, awesome question. So I'm dealing with a lot of business owners, right? And people are very concerned about, if I give you X amount of dollars, how much am I going to take out at what time period? So that's usually the first question. And with whole life insurance, the biggest, or using the strategy at least, is the biggest concern is the fees. So typically with whole life insurance, the fees are going to be the highest in the first 2 years. And so pretty much if I'm talking to a 40-year-old real estate investor and I show him or her, like, this is how much, you put in $10,000 a year for 20 years and they plan on retiring when they're 60, they're going to look at the illustration, the part of the policy that shows a breakdown of numbers. And they're going to say, all right, so year one, I'm giving you 10,000, but I have $5,000 available in cash value in year one. And then year two, I'm giving you another 10,000, and I'm going to have probably like $12,000 or $13,000 in cash value. And then year three and four, and then following, it starts to compound and grow, eventually outpacing what you put into it. And then, but they say they get that part, they like that part, but what happened to the first 2 years? And the answer to that is there's a fee to doing all this. It's not too good to be true.
Right.
There's a cost to this. We're working with insurance companies that are for-profit organizations. So that's kind of the biggest concern I see. But it's a long-term game. It's not short-term. It's not flipping money year after year. It's a long-term game. What happens then is after year three, the policy there's a break-even point, and then the policy starts to earn more dividends and compound interest than you're putting into it. Eventually, putting in $10,000 a year for 20 years could give you $30,000 a year for the next 20 years after that on a tax-free basis or tax advantage basis, because under current tax law, life insurance, cash value in life insurance grows tax deferred. And in most situations, when you take that money out, since you're using after-tax dollars, you're taking the money out tax-free. There's a lot of tax advantages using this, and of course the certainties. So, and it's not either or. So while you're building up this policy and building up the cash value, you can access it, use it for real estate investing. You can even buy stocks with it if you wanted to. You could use it for whatever investment you want without having, and then you have the safety net, So if that investment doesn't do good, you still have your original policy to fall back on.
Yeah. Are there I have another question, but this just came into my head when you were just talking. Do you see, maybe you don't know because you're not maybe not directly involved, but other types of real estate assets that you see your clients going after, buying, using that money for, or is it just kind of like everything, it just depends on the investor?
Yeah, it depends on the investor. I've been seeing that a lot of real estate investors have specific niches, things that they stick to in certain areas and certain parts. But I haven't seen anything where it's like, this is the new thing, this is the hot thing right here.
I gotcha. Yeah, right. The other question I had, which is going to kind of build off of the concerns and stuff, question that I asked before, is if somebody listens to this episode, let's just take this as an example. Somebody listens to this episode and they're like, wow, I really want to talk to Sarry and I want to learn more about this concept. Have you ever had a situation where you look at you do their financial analysis at the beginning and you're just like, this is not a good fit for you? Does that ever exist?
Yeah, it exists when one red flag to that or indicator of that is that if they're too concerned about very short-term money, like money less than a year, then this is not a good fit for them, because it's not a 1-year game. This is something that I help people with retirement. People who are in their 30s, 40s, or even younger than that, who want to retire, but at the same time build predictable wealth, become their own source of financing. People, in other words, who are willing to put in time. So if it looks like they're too concerned about every dollar going into it and getting it out with the return, I'll just tell them, maybe a mutual fund, or maybe, investing in the stock market or day trading is better for you, a better situation, or not better situation, but it's more of it fits more of what's your wants.
Yeah. So then, I just forgot. I had a great question. I just forgot it, but, this is why I run a great quality pro show. I think what my question was going to be is, like, when do you ever have an issue? Because like I forget what episode it was. This is my question. I forget what episode it was. We were talking about something. We weren't talking about this, but we were talking about something where like sometimes it's hard. I think at least, like I'm 30. I don't know how old you are. But like everybody lives in like this world right now where it's like that instant gratification type thing. And you're talking about like, when people come to a financial analyst, they're like, I need this money like now, like they're going to you because they need money quickly. And is it ever a challenge to kind of explain to them, like, listen, like this isn't going to be like a 1-year thing. And like, maybe even if they don't see those returns, like I think you said like after 2 years, right? They may start seeing some returns. Do you ever like have a situation where you have to like, like keep them calm and like get them over that 2-year hump? Is it like, does that ever happen?
Yeah, absolutely. And I think it starts with like, a lot of people need to know this, is that like 60% of Americans don't even have like $1,000 in a bank account saved,
Which is insane.
Yeah. Exactly. Most people can't go, if they miss one paycheck, they need credit cards now to pay the next thing. They need to borrow money from friends, family, there's a lot of like, and that's not an income problem. I think it's a saving problem. Our money is too liquid. It's too fast, Think about how fast you can access your money right now. Debit card, credit card, quick pay, mobile app, bunch of mobile apps. It's so fast to reach your money. Yep. And I think that a strategy to overcome that is to create obstacles between you and your money. You want to create some speed bumps, like some hoops you have to hop through to get to your money. And the bank on yourself strategy can help that. So and people actually like to hear that, because they like to see that, all right, you know what, you're right. That does sound like a good point. If I have, if year one, I put in 10,000 and then whatever, I have 5,000. If I want to access that 5,000, I'd have to fill out a form, wait 5 to 7 business days before I can get up to 90% of that in the first year, for example. And then doing so adds some speed bumps. You're not completely locking up your money for 20 years without touching it, but at the same time, you're making it more accessible than your savings account. Think about how many people move money from their checking account to their savings account online, and then they go back to their savings account, transfer from their savings back into the checking. Are
you talking about me? Is that? Do you know what are you watching me? Have you seen me do that?
Yeah, me too. Yeah. So I think that I show people that you can create some obstacles between you and your money, and you want to do that. You want to, banks and large corporations want us to fly through our money. They want us to access our money in seconds, so we could spend it and keep using their apps and their platforms and everything else, and go into the bank and, to rely on them. But when you have the strategy, you become like your own lender and your own saver. And I think it's powerful just to have, just those small speed bumps. You have to fill out a form, wait 5 to 7 business days, get your money, and then set up a payback period. You're going to think 10 times before you access your money.
Right. Yeah, exactly. I definitely wish I needed to fill out a form, but I mean, like Venmo is so easy, depositing checks online is so easy. Anyway, so maybe I want to go back, and sometimes this happens. I kind of go all over the place, but it's my show and I'll run it how I want. Yeah. So we were talking about before, one of the questions that you had suggested about, investing in your business or saving cash. What about from like an individual perspective? Do you invest? I think maybe kind of going off what you were just talking about, like how, a lot of Americans, 60%, I think you said, don't have $1,000 in their bank account, which again is crazy. But like when you look at like a savings account or like a 401k or all that kind of stuff, I mean, like to me, it seems to me like what you're saying is like that money's sitting there doing nothing. So you would want it moving and like working for you. Right. So is there a difference? Like if you're looking at a business, whether you're looking at a personal, just like a guy like me?
Yeah, of course. Yeah. So it goes to the financial analysis is where we ask like, what are the questions? What do you do for work, or how much income do you earn? If we do a personal financial analysis. Now, if they own a business separately from that, then we'll do an analysis for the business. And typically, depending on the person and the industry they're in and other factors like that, it might be more related. Like the person, for example, that's running the business, it's a small business, like 3 employees, then it's going to be more personal. It's going to be more relatable to their personal financial analysis. But if it's a company like 100 people or more, and they have investors and other things like that, other, cooks at the kitchen, then it's going to be more separate than that. But of course, we wanted our niche is more individual, small business level, people to people,
Right.
even if the client at the end of the day is a business, it's more people to people. So we want to focus more on the client and helping the client get their goals before their business hits their goals. We want to see like, all right, you own this business, it's successful, but what's the exit strategy? Like, do you want to sell the business in X amount of years? Do you want to retire from the business? Is there a way where you can earn passive income from this business and have somebody else manage it for you? Not all, actually, like 80% of businesses don't work that way. They're not sellable or easily transferable or can generate passive income, which is why a lot of real estate investors get into real estate, like
Right.
like an attorney, for example, perfect to get into real estate, because when you're 70 years old, you can't keep going to court making money. You need a way to earn monthly income
Right.
without having to work for that money.
Yeah,
Real
like
estate can
like
do
the
that.
old the passive income. Everybody needs a little
Exactly.
passive, like a little. It's like almost like a side hustle, but sometimes it's a lot more than maybe sometimes people make in their day job, I guess.
Yeah.
But all right, so it seems to me that you are. I mean, this is going to be like the most obvious statement of the day. Very into this bank on yourself concept. So obviously, if people are interested in this and want to learn more about it, outside of going to you, obviously, because you seem to be an expert. Like, what are some other, like, how did you, I know you mentioned the one book earlier.
Mhm.
What are some other ways that you've been able to learn more about this? Maybe suggestions for everybody, that people that just want to educate themselves on this before maybe they go down this road.
Yeah. So there's the first book I recommended, The Bank on Yourself Revolution by Pamela Yellen. There's a second book called Becoming Your Own Banker by Nelson Nash. Nelson Nash is the one who invented the infinite banking concept. And then also, if you Google search or go to YouTube or podcast and you search infinite banking or bank on yourself, there's a ton of content out there about the subject. And let's see what else. And then, yeah, just make sure that if you're reading about this, that it pertains to whole life insurance. You might read something that says, bank on yourself, index universal life. And there's a lot of arguments out there, but you can't, in my opinion, you can't use universal life for the bank on yourself strategy because of the uncertainty with universal life. There's more predictability and certainty with whole life. So it has to be whole life. It has to be the infinite banking way. Also, another key distinction is you want to check to make sure that if an advisor or company is pitching this to you, that they are a mutually owned insurance company as opposed to a stock owned insurance company, because mutual insurance companies give their dividends and profits back to the policy owners, whereas stock-owned insurance companies give their dividends and profits back to the shareholders. Now, I'm not saying to always go with mutual insurance companies as opposed to stock insurance companies, because sometimes that doesn't matter. But I'm saying when it comes to the infinite banking concept and the bank on yourself strategy, you want to make sure that it is a mutual insurance company, because if it's not, then you're not going to be able to utilize this strategy.
Right. Okay. Gotcha. All right. So we'll make sure that we can even like link some of those or mention those in the show notes after. We'll make sure we put all this stuff in there. I'll remind everybody at the end. But I'm interested to know, because like I've had a lot of people on the show that are like small business owners, real estate investors, people that like bet on themselves a lot. And I think that's a great thing, and and everything. And then so you're obviously a small business owner basically, and you deal with people's money. So like there's a lot of swirling winds around failure, right? So like, why don't you take us through like your thoughts on failure?
Yeah. So from my experience, I failed, and I think it's I enjoy the failure because it's definitely like a reality check, and it's something that I've learned from. I never knew those like failures. Failures are pretty much like what's next? What's the next step? They're also like, are this is the worst case scenario, and you've pretty much checked it out. Like for example, I started boxing like 7 years ago,
Oh,
and I
cool.
had a lot of fear about what if I get punched in the face really hard? What if I get punched in the gut really hard, And I went to the gym and I did those things. I got punched in the face really hard a couple of times. I got punched in the gut a couple of times really hard. But then after that, that was the worst case scenario. That was the worst thing that could have happened, I thought. And that's it. I kind of checked it off. And then now it's like, all right, now we can progress from there. Same thing in business and being self-employed as a small business owner. It's like, all right, what if I don't make enough money to pay my bills? I've done that personally. What if I use up my savings and have to use credit cards to pay my bills? I've done that, and then after that, it's like, all right, now what? Like, what's the next bad thing that could happen? And then you kind of learn from that. It makes you stronger. It's like going to boot camp, and then you just get stronger from it. And I like dealing with a lot of business owners because we can relate to that. They've started, most businesses fail. Like I forgot what the stat is. Ridiculous. It's like 80% fail in the first 5 years. But that's not something to deter people from it, because once you fail, like the chances of you failing again go down. And by the time you start your business or restart your business the second or third time, you're like a pro at entrepreneurship. Now you've done it before. You get it.
Right. Yeah. I mean, like I being a guy that played sports and coached sports and all that kind of stuff, like failure is always a thing that just like, especially like in baseball too. I mean, like I mentioned before, like a big baseball guy. I mean, like it's like the old saying, people say it, like if you fail 7 out of 10 times, you're a Hall of Famer or whatever. If you get like a hit 3 out of 10 times, you're going to the Hall of Fame, which is, you're hitting 300. So, but sometimes you just got to like take a chance, roll the dice, bet on yourself and see what happens. Because like, I mean, I've always thought that like, the one person that you can trust and like the one person that if like you have a plan and you want to see that plan through, the one person that's going to be there for you is yourself. I mean, obviously you'll have people surrounding you. It's always good to have like a support system, but you always got to look out for number one. And you're the only person that's really going to kind of, push those goals forward consistently. And you can use your time however you want. Like if you have a goal, like if I have a goal to make the Morning Spotlight the biggest podcast in the country and I sit on my ass and watch Netflix all night, every night, it probably won't get there, but like if I'm working at it and trying different things and trying to get myself out there more, I mean, I think that's kind of what you're saying. So, how'd you get into boxing?
Good question. So I've always wanted to, since I was like 14, living in Chicago, always wanted to. And I just kind of, when I was like, I'm 30 now. So like 7 years ago, I was 23. I just kind of was bored one day and I was like, you know what? This boxing gym opened up and they had all these promotions, like free 1 week pass or whatever. I was like, you know what? I'm just going to do it. Like, I don't care what's going to happen. I didn't start sparring with people. I just started doing the classes. It was more like cardio. And then, I've been doing it since. I've kind of been like, I'm like addicted to it now, and just not even about, punching people or getting punched, but more so just the workout, and it's sport, just same way, basketball, baseball, everything else. You're doing it, because you like to do it.
Right. That's awesome. I think that's so interesting. I always thought I would want to get into that, but I just never have. Like I always like have it in my head that like if I go to a boxing gym, it's gonna be like, I mean, I don't know the one that you go to, but it's gonna be like one of those like seedy, like dark, wet places, and then like the trainer's gonna be like some old guy, and I'm like, I don't think I fit into that crowd, but I don't know what the place you go to is like, if it's like that or not. Like Rocky, like I have to chase chickens and run upstairs, and it's just that's not for me. But
no, it's more of like just like everybody goes there just to like work out. Most people go there just to work out for a cardio, for just.
Right. So have you sparred with people?
Oh yeah. I've sparred hundreds of people. Yeah.
Hundreds of people.
Over the last
have you ever gotten knocked out?
I've gotten knocked down and I've gotten like punched in the gut so hard I had to take like a 20-minute break. I've never like fallen asleep. Yeah, I never like went to sleep.
Have you ever knocked anybody out? That would be badass. You'd be the most bad. Actually, you wouldn't be the most badass person on the show, but you'd be pretty close.
No, I never knocked anybody. I've knocked people down. I've hit people where I've hit people pretty hard, but never again put somebody to sleep. I think it's really hard to do that.
Do you have like we're like so off topic now, but this is how this show normally goes. But do you have like wow, like Sarry's got like a mean right cross or something? Do you have like your punch?
My jab is really
Are you like a righty or a southpaw?
Righty, but my jab is just like super fast. Like a lot of people don't see it coming.
That's good. You don't want people to see it coming. I think that's the whole point, right?
Yeah.
Awesome. But do you ever like you got to wear like the head? What is it, like the head cover thing?
Actually, I don't like to wear the headgear because it like contains the heat in your head and you sweat more, and also your peripherals that get blocked. So you can't
see who's punching you.
Yeah. I just like to be
Yeah.
free. Like even if I'm gonna get like a black eye or something. Like of course in the business world, it's not appropriate to have like marks on your face.
No.
Especially like doing like videos like this.
Yeah.
But
Like it's like Fight Club. Yeah.
Yeah, exactly.
Yeah. That's interesting. I just always like to like learn, something different about whoever's coming on. So, all right. So let's say somebody is listening to this show, and we talked about like doing the financial analysis and everything. Like, what are some ways that people can reach out to you and like take us through like maybe like the steps that they'll have to go through beyond like the financial analysis?
Yeah, good question. So pretty much the first step would be they can go to our website, finassetprotection.com. It's FIN assetprotection.com.
We'll put
There's
that
a
in the
link.
show notes too. Yeah.
Okay. There's a link. You could schedule an appointment, and then it like directs you to Calendly. So you could just pick a time. And usually it starts with an intro call, like a 15-minute call. And then we kind of we get to know each other and get to see like, is this something you want to, proceed with? And then the second step is the financial analysis, the 60 to 90-minute call. But of course, we don't have to rush into it. Some people want to go right into the analysis. Some people want to talk first, pretty much. And then the third step is the solution. Like, are we based off of what we have uncovered in the financial analysis? This is the solution. And then the fourth step is execution, submitting the policy to the insurance company. And then we do 6-month reviews. So it doesn't just stop after execution. It's continue. It keeps going. And every 6 months, we do a policy review and yeah.
Okay. And then, what was I going to ask? So people, they go through that process, right? And again, I forgot what my question was. I'm the worst show host maybe ever. Like I had it, I was like ready to go with it, and then I just like slipped my mind. But all right, so let's figure out like, so they come to you, and then oh my God, this is gonna bother me because like I'm gonna like get off this call and I'm gonna remember what it was. It was a good question too, but so maybe we'll talk about before we get into our closing segment. Just take us through like just kind of your. Oh, that's what I was gonna do. Man, I'm so prepared for this. COVID, like we're going to talk about COVID one more time before we wrap this up. And I know everybody's been beating COVID to death, for lack of a better word. Has that helped you? I'm just interested from like a client, getting more clients. Has that helped you because you're doing it more virtually? Has it been kind of the same? Because like one of the things because I sell title insurance for a living, so I am in the real estate field. And one of the things that I have noticed over the course of 2020 is that I've met way more people over the however many months we've been doing this, 7 months now, I guess. Just because I'm able to like get on a Zoom call or a remote call or do this podcast or do whatever and be talking to, maybe 10 people a day, maybe more. Like, at one point I was talking to probably like 30 people a day at like the peak of the pandemic here in New Jersey back in like March and April. And there were people that like I normally would never, like you and I would never connect outside of like the virtual landscape. And there's been plenty of people like the guy that posted his episode today, Axel Meyerhofer, he's from San Diego, would never have met him outside of a virtual world. So has that changed how your small business operates and how you're able to try to like get yourself out there and try to get more clients?
Yeah, absolutely. So even before COVID, I was still virtual. Like I kind of had that in mind before, like years before COVID, that I wanted to do a virtual, because a lot of insurance and financial advisors get into the practice because it's a virtual practice, but a lot of them do their marketing face to face. They'll go to networking events, they'll go give speeches and presentations. And I was planning on doing that. I was planning on, like working from my home office, but then going out and like talking to people. But then after COVID, of course, that's when I started doing guest podcasting. And I actually like it more than, networking face to face because, again, like you said, you're in New York, you're in New Jersey, I'm in Chicago. We would have never met if we were just going networking face to face, because you'd be out the East Coast, I'd be in the Chicagoland area. But now with podcasting, it's almost like, I'm traveling, the country. Just one day I could be in California and Texas, whatever. Same with you. And even to take it a step further is I've done shows with people in Australia, New Zealand, the UK, one guy in Belgium, it was in English. And so it's almost like you're traveling the world doing this. So I really enjoy, from the marketing side, I really enjoy. The downside to doing everything virtual, I guess, is that it takes longer, like having clients sign forms, going back and forth. They might there's way more delays in that. But ultimately, I like the virtual route more than just the traditional business way.
Yeah. Like I think once all this stuff finally goes away, which hopefully is sooner rather than later, like I do think that there's going to be a good marriage between the virtual world and the in-person world, because I think people, I'm just going to use myself as an example. Like I personally think, and I'm not going to toot my own horn, that I've thrived in a virtual landscape because I was just been able to get my message out to more people and get myself out to more people, different parts of the country, all that kind of stuff. Whereas before, I was always a good networker and all that kind of stuff, and ran my own events and ran my own groups, went to a lot of events. Like I was at something like basically every day, but it's just different. You know, like I can go into a room of 200 people and only meet 5, or I can go on a Zoom with 50 people and meet all 50. You know what I mean? So it's like just like a little bit different, but I digress. So, all right, we're going to move this into our closing segment, which we do for every episode. It's called Under the Spotlight. So we're going to put Sarry Ibrahim under the spotlight. What is one thing you want the people listening to this episode to walk away with? It could be something we've touched on already. It could be something that we haven't touched on that you think is really important that you want to, the people at home to remember. So what is that one thing?
One thing, think like a bank. So a lot of the bank on yourself strategy, it's essentially, becoming your own source of financing, your own source of saving. So, and this is what banks do. Banks literally have billions of dollars in whole life insurance. And if, one thing to take away from this is think like a bank, do what banks do.
Awesome. All right. So that was great. So for everybody listening, like I mentioned earlier, I'm going to take all this stuff. Sarry's going to send me all his links, his email address, his website, the whole deal. And we're going to put those in the show notes. So if you do want to reach out to him, make sure you do that. If you want to be a guest on the Morning Spotlight, or if you want to hear us talk about a specific topic, make sure you go to themorningspotlight.com or email us at themorningspotlight@gmail.com. Sarry, thanks again for doing this. This was awesome, man.
Mike, thank you so much for having me on. I appreciate it.
Absolutely. And everybody else, thanks for listening. We'll catch you next time.